Hey everyone, welcome to the Waypoint Energy webinar. I've been waiting my whole life for this and excited to have Mark Fleming, TJ Johnson, and some of the rest of the Turbine Capital team on today. It's funny, we were just talking in the practice session. TJ, you were burning some gas this morning.
It just got done with two BFM sorties, 20,000 pounds of gas effectively in about 35 minutes. So I'm doing my part.
Perfect. Sounds good. We'll do ours. So, welcome everyone to the Waypoint webinar. This is a very exciting day for us at Turbine Capital. It's the launch of our new energy vertical, and we're very excited to have all of you be a part of it. So, we have a heck of a lot of attendees. Thanks everyone for joining live. We really appreciate you being here live. For anyone who is watching this on recording, thank you for watching the recording. And with that, let's get into things. Everybody seeing this okay? Beautiful. Let's go. So thank you for joining us for the Waypoint Energy 2026 Fund webinar. Quick disclaimer, this is not an offer to sell securities. That will only be done so through the private placement memorandum, which can be found on the dashboard. Quick overview of who we are. Turbine Capital is a leading alternative investment firm that focuses on real estate, energy, and private debt. We oversee asset management, business plan execution, and a white glove experience for our investors. We assemble best-in-class teams and investor-friendly structures around all of these different verticals. Our core values are stewardship, excellence, transparency, adaptability, and camaraderie. These are the values that drive us every day to serve our investors. So, Turbine Capital team, my name is Tait Duryea. I'm the founder and CEO of this company. Our vice president, it should say, of operations, Brittany Ataburcio, is on her way to an industry event in the Midwest. And so she's not joining us live, but she, I think, is tuning in on some aircraft Wi-Fi. We've got TJ Johnson here, who's our investor relations liaison, as well as Noel Vinzon, which is our new investor relations coordinator, which a lot of you have had interactions with. And with that, I'd like to introduce Mark Fleming, who is our new managing partner of oil and gas and the chief investment officer of Waypoint Energy. So, Mark, thanks for joining us.
Yeah, hello everyone, and I'm glad to be here. And thanks, Tate. So my background is I'm a petroleum engineer. Went to Mississippi State University, and I've worked across the industry in several roles: Chevron, EOG, and Hess as a reservoir engineer. And then the last probably 10 years of my career have been evaluating oil and gas properties, mostly unconventional, which brought me to where I am today. I've been advising this group for a while, and I'm excited that we're launching our new fund. We've got a lot of deals in the hopper right now, and I know everyone's excited to get this started. So thanks, Tate.
Thank you, Mark. And we'll talk more about those deals in the hopper and sort of what that looks like and the analysis that Mark does a little bit further on in the presentation. All right, so looking at some macro trends, why oil and gas? Anybody watch Landman? Gotta love some Billy Bob. So oil and gas really truly is in everything. And what he was talking about there is really these blue bars. And this is a chart that shows what is a barrel of oil used for? What is an MCF of gas actually used for? And you see these blue bars here are material feedstock. So even if we were to go 100% electric today, you wouldn't be able to ditch oil and gas because you have to make things with it. So that's called the petrochemical business. And oil and gas is the feedstock of, it's bitumen, it makes paved roads, it's the feedstock of plastics, and it's essential for our everyday lives. So it's not just used for energy and transportation, but it's used for all sorts of things, and it touches every facet of modern day life. And despite trillions of dollars of investment in green energy, we're still 83% dependent on fossil fuels globally. And personally, I've said this before, but I'm actually a bit of a tree hugger. I'm an environmentalist, but the fact is that we're not ready to come off of fossil fuels. And we're in this moment in time where over the next 25 to 30 years, as this transition occurs, we're behind the eight ball on extraction of fossil fuels. This is a report from ExxonMobil that shows the amount of wind energy will grow over the next 25 years from 3%, less than 3%, to about 12%. But the problem is total demand for energy is still increasing. We're at about 600 quadrillion BTUs of energy demand today. We're going to be at nearly 700 quadrillion BTUs of energy demand in 2050. And quite frankly, this report was written before a ton of this AI boom, which is putting even more. I mean, that's piling. We might be up in the 900 or even 1,000, whatever that number is, of BTU by 2050 with all the data center demand. So all this to say is that we have not reached peak oil consumption yet. This is a report from Morningstar. This is linked in the deal room. Highly recommend downloading it. It's a long report from Morningstar that talks about oil demand forecast. And this is by sector. And Morningstar is forecasting that we will see peak oil consumption in the early 2030s with a slow drawdown after that. There's no quick demand decline in sight. And while certain sectors will decline over the next 20, 30 years dramatically, such as light duty vehicles, road freight, things like that, for things like aircraft, you just can't put batteries in aircraft. And most of the people on this webinar are very familiar with why. And so we are forecasting a large increase in demand for those sectors, as well as the petrochemical businesses that we had mentioned before. Rystad is forecasting a spike in energy prices into the 2030s. Obviously, this is before all the turbulence in the Middle East. This is 2026, 26 into 2030. We had Schreiner Parker from Rystad on Hangar Talk a few months ago. That's linked in the deal room as well. If you haven't had a chance to listen to what Schreiner was saying about the Venezuela stuff, he's coming back on in our June Hangar Talk. We haven't 100% confirmed that yet, but he's expected to join us again on Hangar Talk and kind of talk about what's happening in the Middle East. We're structurally oversupplied for the next few years, but going into the 2030s, we're actually looking at a structural undersupply. And this, the Rystad and Morningstar forecasts here for pricing did not take into account anything in the Strait of Hormuz, as this was published before that occurred. It's important to understand that significant continuous investment in oil and gas exploration and drilling is required just in order to maintain flat supply. You don't drill a well and just get the same amount of production out of it for 10, 20, 30 years. It declines. We'll go into what those decline curves look like a little bit further on. But they look basically like this, where you have wells come on very strong in the beginning and they drop off quickly and then they start to kind of level out. But additional investment is required just to maintain flat supply. So the world has changed, but there's still runway for oil and gas. And we see the next decade as being a real sweet spot to be investing in this. So with that, I want to turn it over to Mark to talk about sort of unconventional shale and non-operative working interest and how the U.S. ended up being the #1 oil producer in the world when only 20 years ago, we thought that we were going to be importing oil and gas from abroad for the rest of our lives. So Mark, over to you, and I'm going to give you slide control here.
Okay, thanks, Tait. Yeah, so I did my master's thesis on U.S. energy policy, and it was really fun. Back then, we were predicting more than 70% of the oil at this point in time to be imported from somewhere else. So it's quite a change that's happened over the last 20 years. And most of that has to do with unconventional shale production. These shales have been around, we've known about them, but we only had vertical wells in them. And once we figured out that you could drill a horizontal well through them, then the production went up tenfold, and it only cost 2 or 3 times more. So that's what's got us in the position we're in right now, is a technology plus an economy that allows for that to happen. And here's some additional graphs that show there was a lot of oil and gas papers and Newsweek articles and everything saying that we were at peak production back in the 60s and 70s, and then oil and gas was going to go away by 2030. And that just hadn't been the case. It did start declining pretty heavily, but once the shale revolution hit, which you see there on the left-hand graph, it's from 6 million barrels a day, to close to 14, and it's still slightly rising. And then you can see some more of that on the right-hand side. This is a price of natural gas prices, and the reason we're showing this is, with what's going on in the Middle East, especially, this is very important to us being able to produce oil and gas, especially gas in the U.S., and be able to buy, gas properties, and kind of how the whole, natural gas price and LNG business factors into that. If you look on the On the left-hand graph, natural gas prices have spiked and then come back down, but what's in the red and blue is what they're paying over in Europe. And this graph was generated before the conflict in the Middle East. The prices are back to that and more than that in some places because of the Strait of Hormuz and the closing of several LNG facilities, which is very important because over on the right, people have been thinking about this for a long time, and we used to be geared up to only import LNG all across the US. And back in the mid 2010s and whatnot, some of these companies foresaw the growth in the unconventional gas plays like the Haynesville in northern Louisiana and decided that we need to start building LNG export facilities because of what you see on the left and the prices you can get internationally. This graph below is just a little bit off. It came from the EIA, the Golden Pass LNG facility, which is partially owned by Qatar, by the way. Just came online, but most of those other facilities over there are in the process of coming online. And that's important for us, as we invest in natural gas, because I believe that provides some stability in the natural gas prices. And we've talked on a few other calls that we've had that, we're probably going to target more natural gas than the fund beforehand, just because at this particular moment, we feel like it's a more stable and predictable thing to get into. We're still going to invest in oil, obviously, but this is a good picture here for the US.
And this is just so important to understand. Europe is typically 3 to 4 times the price per MCF of gas than we pay here in the United States. But we have had no export capacity. We haven't had the LNG terminals to get it off of our shores and ship it abroad. So as that comes online, it reasons that it will be a buoying effect to our gas prices here in the US because we can actually export it and fetch much higher prices overseas. This is
Yeah,
just
and
another
this is
graphic. Yeah, go ahead.
Yeah, and this is just the US. The graphic before showed some Mexico and other regional LNG facilities. And these things cost tens of billions of dollars, by the way, and they take 10 to 15 years of design. And so they're not cheap investments and they take a long time to get on production. But once they do, they're golden. I've seen a couple of graphics of all the ships that were coming in and out of these in the Gulf of Mexico before the conflict versus now, and the number of ships that are coming over here to get natural gas has, I think, gone up a factor of 10. A lot of them that were headed to the Strait of Hormuz turned around and came here. And so, what is horizontal well drilling? Well, in the past, on the bottom graph, wells were vertical. Sometimes they were directional, mostly in the Gulf of Mexico and international, but there just weren't a lot of horizontal wells in the US. And so, one of the guys that founded the Woodlands here in Houston, the company was named Mitchell Energy. They started doing this in the Barnett Shale, which is around the DFW airport. They started drilling horizontal wells half a mile long and then 1 mile long, and they started fracking them with sand. Fracking's not new. You hear about it all the time. Kind of sounds like it's a new technology, but it's not. I was doing this in West Texas back in the early 90s, but the technology around it it has taken quantum leaps. And same thing with drilling of wells. 1 or 2 mile well back, when I started in the industry would have taken 30, 60 days sometimes. And now they're drilling these in several weeks. So a lot of things have changed. And over on the bottom right is just kind of an example of how the well will go down and go through the producing formation, goes through groundwater aquifers. There's, shales and producing formations. And you can see just the amount of wellbore that touches the reservoir is significantly different from the left picture to the right. And on the graph on top there with the different years, that just shows one of the areas we were evaluating, the number of horizontal wells drilled per year in that particular area. I think this is Wyoming where we were evaluating a well.
I think this is important to understand the de-risking of drilling over the last few decades versus when a lot of these tax benefits were brought in the 1940s, 1950s that allowed for significant non-passive losses to be taken to offset active income for investors. And that was to encourage drilling because it was risky. It was 1 in 3 wells would fail or not be commercially viable. Now, today, you can see as the years go by and horizontal well bores are drilled right next to each other, the rate of non-commercial viability or failure has come down dramatically. Mark, you got anything to add to that?
I was going to answer the question that just came in on any strategy to mitigate political risk. A majority, 90 something percent of the oil and gas that we use here in the US comes from the US. So while the prices have gone up and that's just people taking, advantage of the market, doesn't really affect our ability to get oil and natural gas. In fact, we're absolutely in the driver's seat right here. The only thing we would be able to do is potentially hedge, and we're going to look at that next year once prices settle back down. That's the only way we can think of to mitigate political risk. Well, first of all, is just to invest only in the U.S.
Yeah. I would also say that the 2026 fund is going to deploy all of the 2026 capital within this calendar year. And so if you're talking about maybe from one political administration to the next, the wells that are being drilled into the 2026 fund have to do with the 2026 political environment.
And, the latter end of that question, this is one of the cheapest places there is for a whole lot of reasons to explore for oil and gas, mostly due to the economy and just the way the government is so friendly here.
Yeah.
And these are just some basics on horizontal drilling and fracking. We drill the well to the desired depth and we turn horizontally, then we perforate it. They're actually large guns that go downhole that blast big holes. And then we have a viscous fluid that pumps sand down into the formation, and the sand breaks up the formation, which is what you call fracking. And like it says on the right hand side, you can talk about this another time, but there's just a whole lot of technology, hundreds of different inventions that have come into play across the last 20 years that just make this a lot easier to do than it was beforehand. So let's talk about non-op, kind of why are we in the non-op business? So there's a lot of companies that go out there and drill wells, and this is important to understand. And some of these companies have owned these leases for 40 or 50 years. They may have had vertical wells in them beforehand, or they may have purchased the wells recently, but they've gone out, spent money exploring, hiring staff. They've got huge budgets, lots of software, and the cost that goes into, acquiring that and drilling test wells and, learning new technology and whatnot is great. So for us to be able to participate in that is just great. It's great. We're not having to, although we do have to pay somewhat of a price to get into some of these wells, we're not having to do all that work, and we can manage this with a very small team. And the question's been asked several times, well, why would somebody give that up? So let's just say a company like EOG, where we're participating in a well with them, they're probably not going to give up their interest in a well, but they don't own 100% in most of their wells. So there's some local landowners and smaller companies that own interests in all these different companies. And so when the well's about to be drilled, companies such as EOG and Oxy and BPX will send out letters and say, does anybody want to participate in this well with us? And so that's what I was brought on board to get us on those lists to where we can go shake a hand at one of these companies or go to a meeting with one of these companies. And as a follow-up to that, we'll usually meet with them. It's a very personal business. You don't just sign up for the list on some website. They check you out first, make sure they like you. I mean, we've had several of them investigate, our fund and make sure they like us. And but after all that, and this has been a 6, 7 month process for some of these companies, but we're in the seat now to start evaluating deals, and they've been coming in 5 to 6 a week. So how are we finding these opportunities? I personally go to 4 or 5 monthly events here in Houston, sometimes Dallas, Oklahoma City, Midland. There's a whole lot of conferences out there. There's some people that host private dinners so that they can connect investors with people that have things to sell. Been to a few family office events as well. There's also some websites that sell these. I went to an auction last week and bid on some Bakken properties. And there's also a pretty big network of landmen, kind of like you see on the show, and legal contacts they just have one-on-one relationships with landowners. A lot of people don't want their name out there and don't want to be on a website. And so let's just say it's some family in West Texas, for example, maybe the kids own the land now and they don't want to keep spending money participating in wells. Well, they'll typically have a landman that they're very familiar with who they've hired to privately market deals.
We just wanted to show what this looked like in practice, right? So when Mark gets a deal across his desk, what it looks like, and then the diligence process that occurs after the fact. So, Mark, if you want to kind of speak to this.
Yeah, so this is one example. Just wanted to show y'all. It was a well with an email, excuse me, with about 20 different attachments. This connection came through a bit of hard work to get in the door there, and they did qualify Turbine and us personally, and had a couple discussions, and then we met up with them during Nate when Tait was down there with me, one of the folks, and so they put us on their list, and this was a well that's about to be drilled. We evaluated this one just to kind of get some practice. We weren't able to bid on this because of the timing, but it's just an example of a major operator, reputable operator that has a well that needs to be drilled, and they want participation in it. So these are the kind of things that we'll be doing. It's quick turnaround too, by the way. Most of the time when they send this, they want to know in 1 to 2 weeks, can we participate in it?
Right.
And so the due diligence is a very important part of that. So we have a process. These are a couple graphics of that, and I'll get into the details on the next slides on exactly what that due diligence process is. So first, we're going to go look at the area. Where are these wells being drilled? Who's drilling around us? How many wells have been drilled recently? Permitted? Are the rigs on location? It's a quick analysis, but there's some pretty good software out there that we subscribe to that, if you know how to use it, that we can do that. We want to look at operational trends, make sure we're not, doing business with an operator that is doing poorly compared to others. When we use the term reputable operator in some of our slides, it doesn't necessarily have to be BP or Oxy. A lot of times a team will quit EOG. It just happened a couple of months ago, and then they go start their own company. And so it's a team that's reputable and has done a fantastic job where they were beforehand, but they might be investing their dollars under a new company name. And we actually invested with a group like that last year that was a spin-off of another company. And that happens to be those wells of ours that came on production in Iron Horse in January. It's kind of an unknown company, but the people that are there were well known in their prior history. We go in there well by well and look at each well in the area of interest. So in this example, this was some wells that were drilled previously to the area we were getting in, and the wells just came on production. So, it's important to forecast those wells, but it's also really important to look at the wells around it. And so this is just a screenshot from one of the software programs I use where we go in there and forecast each individual well. We'll grab however many wells we feel is necessary around the targeted area and look at each well individually. And this is a very meticulous process. This is not some just automatic push a button thing. We go through each one of these and make sure they all make sense. And then what we're doing after that is it's a statistical analysis. We're looking at percentiles. What's the best well? What's the worst well? What's the average well? Is there a big range in uncertainty? Is one well 10 times the other? Or are they all in a tight little window? And then we'll use this to generate our type curve and sensitivity analysis. So once we pick kind of our best guess, we come in there and put this in a program and sensitize on things. As you can probably imagine, pricing is the biggest driver here by far. The reserves will probably be second, but that's something I feel like we have a pretty good handle on compared to offset wells. But this, helps us get comfortable with a number, and then we can turn around and make a bid.
I think it's worth mentioning as well that there's a little bit of art as well as the science. Do you want to speak to that a little bit?
What was the question again? I'm sorry.
Just the art versus science, because, I mean, this is a lot of scientific data that we're putting up on the screen here, but, we've talked in the past about how a lot like flying an airplane, there's a little bit of art to it. Every approach isn't going to be exactly the same. It depends on weather conditions. It depends on all sorts of things, right? And so when you're evaluating well, you're not just going off hard data. You're also going off of some subjective factors as well.
Sure. So, that would include looking at operators, maybe throwing out a few wells if you find out they were completed, in some odd way. Sometimes there's some wells that are abnormally high, and I might throw one of those out too. Yeah. And then, I'm usually making phone calls to people that I know, seeing if they're seeing the same thing when I'm evaluating something. Yeah. So there's relationships involved with this. This is not something AI could do. Maybe it could learn, I don't know, but most of these tools have a lot of a hand input. But I will tell you that this process, of evaluating, let's just say a couple hundred wells would have taken me 2 to 3 weeks with the software that was there 15, 20 years ago. And now I can go up on the internet, type in some well locations, grab a bunch of data, and, I can probably do a quick analysis in a few hours.
Oh,
So it's,
excellent.
yeah, so you got to know how to use the software. Someone asked that, does the oil price spike impact our bids? At this point, no, not at all, because, you got to remember, if we bid on a well today, it's probably not coming on till later this year. And I would say, we'll be lucky if we have something that comes on this year. And so if you look at the market prices a year out, they've already settled back down to the high 70s.
I actually have
Take,
that pulled up.
yeah,
I can go through it right now. If you type in WTI crude futures into Google, this will come up from CME Group, and you can see that if you want to take delivery of oil in July, it's at, today it's at 95, it's at 90 in July, and it slowly is coming down. So this is basically the market, the futures market, pricing oil out, that if you want oil summer of next year, it's at $73 a barrel. This is more indicative when you look at what the prices are at 12-ish months out. That's more indicative of the demand to buy AFEs, or the demand to get into these drilling projects, more than the spot price that you're seeing on the ticker symbol today. Because this stuff doesn't move in a knee-jerk reaction. The industry is fairly disciplined and long-term focused.
not the first time we've had a price spike.
Yeah, exactly. Thanks, Mark. So with that, we'd like to introduce the Waypoint Energy 2026 Fund. We've given you a little bit of a peek behind the curtain in terms of how we're building the portfolio. What Mark's role is. Really, Mark is on the B2B side. We are on the investor relations, the fund administration, all that sort of thing. Mark's out there really pounding the pavement, finding the wells to put into the portfolio. So with that, the 2026 fund, diversified U.S. domestic drilling. It is very similar to the strategy that we had last year, where we're targeting a less than 10% working interest in any one well in order to spread our asset level risk around. We are only partnering with top tier companies, or at least with companies that have top talent. We're targeting over 5 geographical basins, maybe even 6, mixture of oil and gas. We've modeled it at a 50-50, but we obviously have some flexibility on either side there. Transparent, investor-friendly structure, and front-loaded monthly income with strong tax advantages. The fund timeline, we're launching, well, we missed the April 20th by just a couple days. We were targeting that April 15th launch, but the back and forth of legal documents and things, we pushed back a week. But the fund is currently open for investment. We opened just at the beginning of this webinar. As soon as funds start flowing in, we're ready. We've got deals in the hopper, and we're excited to see the fund with the initial assets. The wells will be drilled and completed over the course of the next just under 12 months. So wells have to be spud by March 31st of 2027 in order for the tax benefits to fall in the 2026 calendar year. So you can see that time frame for wells being drilled and completed there. We have some early investor share price discounts, which we'll get into, but final close is on December 31st. And then we will do a general partner to limited partner transition in Q2 of 2028. So early to mid 2028 is when we're converting to limited partners. We can get into that as well. I want to talk a little bit about how money comes back to you in an oil and gas fund. So I'm going to flip over to this slide, and this is indicative of your typical real estate deal. And don't get me wrong, I'm a huge proponent of real estate. I love it. I have a lot of money in it, but real estate deals are very illiquid. $100,000 investment up front, and then a trickle of cash flow for 3-4+ years, and then a big pop at the end when the asset finally sells. The tax benefit here is in gray because depending on your individual tax situation, you may be able to use it or not. If you have a bunch of profitable rental properties, you're going to be able to use this tax benefit. If you don't, then that tax loss, right, is just going to continue carrying forward every year until you finally sell. Whereas in oil and gas, everything is front loaded. So big upfront tax benefit, which you can use against your W-2 income. And so part of that first year return is coming from the IRS, and part of it is from the production revenue of the wells that are coming online. This is what it actually looks like in practice. This is what we've underwritten for the Waypoint Energy 2026 fund on a $100,000 investment, looking at production revenue starting to come in Q1 of 2027, in the neighborhood of 45% in year one as these wells start to come online. That is, of course, increased by the tax refund that you would recognize from the 2026 year. And assuming you were in the 35% tax bracket, and we can show you this is coming from our fancy new investment calculator, which we're going to share with everyone. And it's also linked in our deal room. You can actually come in here, put in your investment amount, your tax bracket, and you can even play with the commodity prices and see exactly how this will shake out without and with the tax benefit. Of course, it does not take into account state taxes. So if you're in a tax bracket in your state, you could also add that on as well. But this is what it's looking like is with the tax benefit. You're looking at a full return of capital, just over 2 years without the tax benefit. It takes a little longer at year 5, but we've underwritten this fund at a higher $70 oil base price than last year's fund at 65. We did that for a number of reasons. One is that we think we have found a new base price in the oil market. And we've also built in some additional conservatisms elsewhere in the model. I think people will find this really cool. This is what it looks like, and this is available for download. And it's an Excel file. Mark, do you want to talk about how you've modeled these on a monthly? We've got a monthly oil program and a monthly gas program. Shows the decline curve, shows the exact production of these representative programs, and this is what everything's being driven on.
Yeah, so for the oil program, we took one of the programs we invested in last year. It has now come on production, so we've got a pretty good idea what that's going to do. And then for the gas program, it was actually that AFE email that you saw. We went and fully evaluated that, and that's I think what's going to be a pretty typical gas program that'll come in the door. And we've got them modeled at 50%, 50% right now in terms of weight of the program. That obviously may or may not shift during the year, but for the moment, we're going to say 50% of our money goes into oil and 50% gas.
There it is. So definitely check that out. We spent a lot of time working on this model, and these sensitivities are also available in the Excel sheet, but we have them here on the slide as well. So these are fixed. They're static. If you mess with the commodity prices on the investment calculator, it's not going to change these because you have on the y-axis here, you have commodity prices, and on the x-axis, you've got production levels, either base case, and then we've got a 15% up or down deviation from what our base case production levels are. And this is the equity multiple over 10 years without the tax benefit and with the tax benefit. And of course, this is going to look fairly weak compared to a real estate deal, and that's how it goes. There are ways that you can increase the equity multiple by recycling a bunch of this upfront cash that you're getting in the early years. And there are some funds that do that, but we like the idea of just distributing everything out to investors because that's going to increase your internal rate of return, which is the velocity of money, how quickly cash comes back to you. And it balances real estate very nicely when you're having to wait multiple years to see a return on your real estate deals. Oil and gas deals, you get that really nice, healthy cash flow upfront. Obviously, the higher tax bracket you're in, the more potent these benefits will be. So with that, I'm going to take us through a little bit of a tax treatment masterclass here. So we get emails from investors all the time that say, hey, my CPA says I can't use these write-offs against my W-2 because I didn't materially participate. And we have to say, okay, tell your CPA to go look at section IRC 263C and IRS publication 925. And they usually come back and say, okay, they got it now. A working interest in oil and gas well that you hold directly or through an entity like ours that does not limit your liability, such as a general partner interest in a partnership. It does not matter whether you materially participated for the tax year. This is one of the only freebies that the IRS has for high-income W-2 professionals. You think about the real estate professional status, you have to have that 750 hours of real estate related activities, 500 hours material participation. You got to do more in real estate than you do in your day job. Very difficult. Short-term rental is fantastic, but again, you have to spend that 100 hours working on that short-term rental, and you can only depreciate what's associated with that asset. It is completely passive. So even though you are not materially participating and you are, for all intents and purposes, a passive investor in the deal, you're able to use these losses directly against active income. How does that work? These are rules that were written all the way back in the 1940s. They made it into the Internal Revenue Code in the 1950s, and they have to do with intangible drilling costs. So what are intangible drilling costs, or IDCs? They're things that you can't sell after you're done using them, right? You can't sell labor and wages or site clearing or testing or fuel or frac fluids or geological survey. You can't sell secondhand. So these things are intangible drilling costs, and those are expensible in the year that they're incurred. So if a well is going to be drilled this year, there's going to be a ton of IDCs that go into the drilling of that well. In fact, on a $10 to $15 million well, surprisingly, only 10 to 20% is actually physical materials that go down the wellbore. The rest of it is going to be in these IDCs. Typically, tangible drilling costs, the other part of the drilling costs, are depreciated over 7 years. But under the big beautiful bill with bonus depreciation, we are able to bonus depreciate those under the current tax law. So it makes it even better. This is a redacted K1 from last year. We target 80 to 90% write-off on your investment. So if you're investing $100,000, you should expect to see somewhere between $80,000 and $90,000 phantom loss on that K1. We did very well last year. We got a 95.5% tax write-off. And so if you assume that this investor was in the 37% tax bracket, which of course is the highest, and they were in an 11% state tax bracket, they could potentially have invested $100,000 in this deal and have really only been out of pocket $54,150. And this is the IRS subsidizing your investment. This is the IRS saying, we want private individuals to invest in oil and gas drilling in the United States. And we want them to take that risk. And in order to incentivize it, we're going to subsidize it. We're literally going to become a partner with you in this investment. And we're going to share, if you're in the 30, even if you're in the 32% tax bracket with in a state that has no income tax, you're talking about the federal government subsidizing somewhere in the neighborhood, well, you'd say 32% of your investment, multiplied by, let's say, 95.5% in this case, nearly a third of your investment. So that's why we love it. It is a wonderful addition to a portfolio, and it balances other real estate investments very nicely. That is the first year tax benefit. But that's not all. There are additional tax benefits on the ongoing production, and that's called the depletion allowance. Another freebie that the IRS just gives you is that they say, okay, anything that comes back to you, no matter how many years it comes back to you and in what amounts, 15% of it's tax-free. So if you receive $45,000 worth of production revenue in the first year of the investment, you're going to take 15% of that. $67.50 is going to be non-taxable, and the remaining $38,250 you're going to pay ordinary income tax on. It's going to be just like you earned it in your normal day job. The other cool thing is that there's no recapture. So in real estate, if you use that passive loss, you're going to have to give it back later. If you buy a rental property and you depreciate it, or that short-term rental, you get that big tax write-off, and then you sell without doing a 1031 exchange, you're going to have to recapture that loss. There is no recapture in oil and gas as long as we sell for less than the taxable basis. And we can get into that during the Q&A. For more on tax benefits, definitely download our ebook. It's a bit of a long read, but it goes deep into the non-operative working interest strategy, how that works, as well as how these tax benefits work. With that, we're going to run through the investment share classes, early investor, share price discounts, things like that. So we've got 3 share classes here, Class A, B, and C at a $50,000, $250,000, and a $2 million minimum with 80%, 85%, and 90% splits to investors. Fees are going to be 4% in year 1, which are half of what they were last year. And then that drops down to a 2% in years 1 and 2. So we're calling this year 0 in 2026, 27 and 28, 2%, and then it drops down to 1% in all the subsequent years until the fund is wound up and dissolved sometime in years 7 to 10. The early investor discount schedule, this is based on when funds are initiated via either ACH or wire. This is an adjustment to your unit count. So if you invested $100,000, and this is actually a typo, it's $1,000 per unit. So just move the decimal point over a couple places, but the math still works. There's no change to your capital balance. So it's still going to show that you invested $100,000. and there's no change to your IDC allocation. So the tax benefits are going to be split up pro rata based on dollar amount, not on unit count, but the distributions that eventually come will be based on unit count. And so investors that come in early will have a larger share by a ratio of 10% if they come in either April or May. And then, of course, these drop off throughout the year. We feel like this is a nice balance, appropriately incentivizing early investments. We need to seed the fund with some great assets. And we don't want to be time compressed buyers at the very end of the year. We want to be able to effectively allocate dollars throughout the year as we go along, all the way to December when there's a 0% share price discount. We do allow bolt-on investments in increments of $1,000. So once you meet that minimum at any time throughout the rest of the year, you can add 1,000, 5,000, 10,000, whatever you want. The new investment will not get the original share price discount, right? So if you invest 50K now and you get the 10% share price discount, the 50,000 will have that 10% share price discount. If you invest 5,000 later in, let's say, October, it will have a 2% discount applied to that additional investment that you made in October. However, if you invest, let's say at 125 now and 125 later in the year, your entire $250,000 cumulative investment will be bumped up to that Class B share. And buddy bidding is available if you'd like to break the minimum. By all means, just reach out to our team. Titling your investment. This is an important distinction, and I know that there are probably some questions in the chat. We're going to get to those in just a minute. We're almost done. We're almost going to Q&A. But this is a very important section of the webinar here because this is talking about general partner interest or limited partner interest. You have the option to choose whether you would like to come in as a GP or an LP. On all of the real estate deals that you're used to seeing, you are a limited partner in that, and it means that you're a passive investor. For all intents and purposes, it means being a general partner in this fund means the exact same thing. It's just that as you come in as a general partner, you're going to be able to take non-passive losses. You're going to count your K1 as active, and you'll be able to apply it against your W2. There are some things that come along with that. It means that you are more of a co-owner. You are more of an active participant in the fund. What that means is that if there were cost overruns, we're going to have to get help from the GPs. If there, God forbid, some environmental disaster happens and there's a suit and our fund owes an additional, let's say, $1 million, that's going to flow through on a pro rata basis to our investors. But this is one of the reasons why we're hyper diversified. We only want a very small piece of every one well. And when I say that we're targeting less than 10%, there are some wells that we're looking at picking up at a 2, 3, 5% working interest. So we're going to have a lot of diversification in the fund, which, we did some Q&A last year on what it means to be a general partner in an oil and gas fund. We'll be doing additional sessions on how this works and, what the quote unquote worst case scenario looks like. And, I think we got very comfortable last year with understanding what those risks are against the benefits. We'll do that again this year in terms of educating investors. But the long and short of it is that if you'd like the active tax benefits, it's how I'll be investing is as a general partner. We recommend that you take title as an individual, a joint, or a revocable living trust that does not limit your liability, because as soon as you limit your liability, you invest via an LLC, you are triggering passive tax treatment. So if you don't care about the active tax treatment and you want to invest as a limited partner, we recommend you invest as an LLC, and vice versa. If you are investing via an LLC and you're going to get that passive tax treatment, you might as well invest as a limited partner. Hopefully that makes sense. So next steps, the fund is open. We are so excited. We're finally open. Next steps are obviously navigate to the deal room and go right through the commitment flow. So with that, I want to open it up to Q&A. We are just so excited about this deal. And we've been working on this for upwards of 5-6 months now. So in any case, let's get to the Q&A here. TJ, if you want to come on camera, I don't know if you're still available, but we'd love to have you for the Q&A session as well.
Indeed, absolutely. We have a lot of great questions that are all in the webinar chat. Those are going to be direct to the panelists, so we can see those. And I'm happy to start reading those out for you if you want to answer those.
That'd be great if you don't mind.
Yeah, you got it. Jumping all the way back up to the top. Thank you, everyone, for submitting your questions. Ben had a great question. If you invest 100K and when you start receiving distributions, are those return of capital until you hit the 100K mark? And then do the distributions become taxable?
So good question, Ben. No, that you're kind of thinking about this like a real estate deal where there's a return of capital. There is no return of capital in oil and gas, right? Because we're going to go spend, let's say, well, we're not going to spend the entire 10 to 15 million, right? But let's say EOG goes and spends 10 to 15 million dollars to drill the well, and then they deplete it over the course of 10 years and they sell it. They're not going to be able to get what they put into it, right? They're only going to be able to sell that asset for maybe two, three, $4 million after putting in 10 to 15. So there is no return of capital. The return is coming through production. And that's why the IRS gives you that 15% depletion allowance, is to say, hey, we realize that there's not going to be a recapture. There's not going to be a return at the end. And so we're going to allow you to just take this depletion, this 15% of your ongoing revenue tax free until you exit the deal. Hopefully that makes sense.
Awesome. Brian C had a question. The short-term spike in oil prices, does it impact our bids? We talked about that with the futures, but we can chat more about it. Effectively, are the short-term top of the market prices right now going to affect us? If you want to just readdress that.
Mark?
No, I don't think so. We're talking to people out there in the industry that are buying and selling. Maybe a slight increase right now, but most people are kind of acting, the way they were beforehand. And I've heard that from a whole lot of people. And I don't know that the geopolitical situation is going to settle down anytime soon. So I don't think it makes sense to just wait when there's deals out there that can be done for a reasonable price.
Awesome. Thanks. And then from John George, has the ebook been modified at all from the original last year?
We didn't have time. We'd like
Busy
to
getting these
update it
deals.
later this year, but it was a push to get this deal launched, and we just didn't have time to go and revise it. We did kind of review it, and all of the information is in there is still valid. But if you read it last year, all of the same information is in there as well. It has not been modified since last year.
Awesome. Let's see. Just a quick response to JH Chang's. The strategy is going to be to purchase new wells, right? So we'll be drilling new wells. His question was purchase of existing wells or drilling new wells or both. And the answer
Great
is new.
question.
So go ahead.
Yeah, so this is going to be all new wells, and the reason for that is that's where you get the tax benefits, the big upfront active tax write-offs. You saw we had a 95.5% on last year's fund was investors were able to take that against their active income. You don't get that buying PDP or proven developed producing assets. There's a huge market for PDP. So in fact, we have done a couple funds that's the strategy. We're picking up PDP, we're recycling cash flow into more assets and sort of growing that portfolio. The problem with that is very low cash flow. It takes a long time to mature. It looks a lot like a real estate deal, and then there's no real upfront tax benefits. So that's why we like this strategy, is that you got to go out and drill new wells in order to get that big upfront tax benefit.
Awesome. Sean had a great question about the Excel spreadsheet. I'm just asking, does that account for the 80/20 Class A share split? And does it include the fees?
Everything is based on a Class A. Yes. Everything that you're seeing in terms, well, and I should caveat that with, I'm still sharing my screen here. This is a dynamic field. So if you were to put in 300,000, it automatically changes your share class to B, and it will adjust the projections accordingly. But it defaults
Awesome.
to 100,000, which is a Class A. Yeah. Good question.
Perfect. Cool. Let's see, jumping back over. Hey, Matt, let's see. Can you explain the exit strategy again in regards to the tax recapture?
Great question. So, Mark, do you want to talk about sort of the exit strategy more generally, and then I can speak a little bit more to the tax side of things? Like when are we looking to wrap up and sell off these assets?
Sure. Since they decline so rapidly, we kind of think a 7 to 10 year time frame, obviously depending on the market at that time, would be a good time to get rid of those. And the dynamics and just market indices and whatnot off producing assets are different than AFEs. So we should be able to get, if we play our cards the right way, a different dollar per BOE, hopefully higher than what we had to pay to get into this deal. Because there's a whole nother group of people that just go out there and buy producing assets and then start trimming costs and whatnot to where they can operate them, as cheap as possible going forward. So there's a whole lot of companies that do that, and there would be a pretty strong market for a big package of wells. I see them being sold all the time. We just aren't bidding on those kind of things right now.
And then I'll speak to the tax side. What we want to do is sell these assets for just below taxable basis. So you have $100,000 in the deal. What we want to do is sell the assets so that we can give investors back $14,999 because you won't have to pay recapture tax on any of those dollars. So we either want to get right under the taxable basis, or we want to give you back 40,000 and say, hey, you're sad because you have to pay tax, but you're not that sad because we got a really great deal on this sale. We are going to thread that needle when the time comes and make a determination based on commodity prices, the secondary market, our tax basis, how good the cash flow is, or how poor it is, when to dispose of those assets and wind up the fund. TJ, what else we got?
Yeah, Josh had some good questions. Okay, so effectively, can there be a capital call? And the question was, should investors expect cost overruns during the investment that will flow through to the GPs, and how will this fund mitigate the risk?
Really good question. So the answer is yes. We can't get around that when you're investing as a GP. If there are cost overruns, it is borne by the fund and vis-a-vis the general partners. That being said, it's our job to mitigate that through disciplined management of cash. Last year, we had a 5% contingency fund. You remember that? We are going to do the exact same thing. We're just not calling it that. At the end of the day, we think that's a little bit of a marketing buzzword to just say that, oh, we have a contingency fund. It's like, yeah, of course we have a contingency fund. We're just not putting a label on it and saying it's going to be exactly 5%. So the first thing we'll do is we'll manage cash very diligently. The next is that as wells come online, all we have to do is divert cash from incoming production revenue in order to band-aid something that's unexpected, so to speak. This is all outlined in the legal documents, but we do not expect any capital calls. That would be an extenuating circumstance, in our opinion. If we had to do a capital call, we're going to exercise every other option available to us first, including obviously dipping into contingency reserves. We can divert production revenue. We can loan personal funds to the fund. We can sell additional share classes that would be, on par with the outstanding share classes to let additional money into the fund so that investors don't have to come out of pocket with additional cash. Of course, investors would have the opportunity to participate in that round in order to increase their allocation. And then as a last resort, come back to investors and say, hey, we need, an additional 5% in order to cover this completely unexpected cost. But we do not expect capital calls.
Fantastic. This question was directly to Mark, but really anybody on this side if you want. Has anyone seen a lawsuit that actually flows through to the GPs beyond what insurance could cover?
I haven't seen that, and your percentage that you would own in, the larger well is so small that it would be very hard, I think, for that to ripple down to you personally, especially with some of these operators' liability insurance that they already carry. We don't expect that to happen, and no, I haven't seen it happen.
We've obviously been talking almost daily with one of the top law firms in Houston as we've been building the legal documents that are now available on the investor portal. And we were talking a lot about the GP liability and all of this, as we were building the fund and, the GP recourse and things like that. And nobody in their law firm has ever seen something work its way through to individual investors as well. So could it happen? yes, but it's an astronomical possibility. And we feel like through the pure diversification of the fund, we've mitigated that very effectively.
Yep.
I do want to
Fantastic.
touch someone was talking about the Excel sheet slightly underperforms in relation to the Iron Horse Fund last year. I want to address this because it's come up multiple times. Projections are just projections. And what I want to instill in every one of our investors is that you should not make an investment decision based on exactly what an IRR is. It is, we do our best to model what we think is going to perform based on what we believe is realistic and but also conservative. We don't want to overpromise and underdeliver. That's never the goal. And so as we built this fund, as mentioned, we decided to use $70 as a base case, but we got a lot more granular in a lot of different areas. You can see that the oil and gas programs that we used as representative averages for the entire fund are based on real world data that's available to you in the spreadsheet, and we've built in some more conservatisms on some of that production. Um, Mark, I don't know if you want to speak any more to that, but I mean, this is one of the issues with investing in oil and gas that investors really need to get comfortable with is that we have no idea where oil and gas prices will be 12 months from now. No one does. If we knew that, we wouldn't be investing in it. We'd be traders. And so certain vintages will perform better than others just based on the commodity prices because the commodity prices are going to be the largest single factor that affects how this fund performs. But in terms of how we've modeled it, yeah, Mark, I don't know if you want to just speak to sort of the difference between the model last year and the model this year, or
Yeah,
if you
just
have any
like you
additional
said,
insight.
just like you said, it's more granular, and we've got the exit built in. We've got, I think
Mhm.
world data, real world timing, just like you said. We're still trying to be conservative, and it's not that we weren't last year, but this is just our model this year, not somebody else's. And so we built it
Yeah.
from the ground up and understand every piece of it. Another thing to mention on the pricing is we're using a flat pricing right now. When we throw in the current market pricing, we've done this probably 20 times since the war started because it changes every day. Those economics, you get a bump up in price for sure. I mean, in economics, excuse me, if you put today's market pricing in there going forward on a month to month basis. And so, there's a lot of conservatism built into this. The same thing with the exit price. I don't think we'll get a PV10 exit price, but that is what we have in the model. I'll probably hold on to it if that's what the market states, and we'll wait for a better price. But once again, just trying to be conservative here.
2 points I want to make. One, you are using a steeper decline curve than last year as well, which is some additional conservatism there. You'll see that the distributions drop off more aggressively. So we've built in a little bit more conservatism there. And then do you want to explain to investors what PV10 is?
Yep. So that's just the cash flow discounted at a 10% rate of return. So if you thought you could get 10% in something else, that's what you use to compare. And that's
Excellent.
kind of what
So
the industry uses when purchasing and buying and selling properties. And it's what all the companies report with the Securities and Exchange Commission. So and it's what the banks loan on. So it's a pretty commonly oil and gas used, discount method and rate.
right. And I think what you're saying is that's a conservative exit price.
Yes, correct.
TJ, what else we got?
Let's see. Julie had a question really about investing in an LLC for the GP. And just to reiterate, or do you want to
Yeah,
attack that?
sure. Sure. So, Julie, good question. So, if you want to offset W-2 income, you're going to have to invest as an individual or as joint tenants with yourself and a spouse or in a revocable living trust, something like that, an entity that does not limit your liability. If you invest via an LLC, it triggers passive tax treatment and you will not be able to offset W-2 income. And so that's why we see that the vast majority of our investors who come into these deals invest as general partner. They select general partner, obviously, and they invest via their individual name or joint. We will have another separate session that's going to go deep into sort of how the general partnership interest works and all that sort of stuff. But that is the long and short of it is if you want the active tax write-offs, you got to come in as a GP without coming in under an LLC. It has to be in your individual name. Now, we are going to transition everyone from general partner to limited partner in early 28, Q1 to Q2 of 2028. Once we make that transition, go for it. Let our team know, and you can do a transfer of interest into your LLC. But while those drilling costs are being deployed, you want to be in the deal as an individual, as a GP, so that you can take those tax benefits as active.
Tate, there's a question on how many wells we're planning for this fund. We don't know yet. We're going to try and buy a lot of very small interests. So I would say probably a minimum of 25, but it could be a lot bigger than that if we buy a bunch of very small interest. And not having any money yet, we can't go out there and buy anything just yet, but we've got several deals that we're looking on where bids are due here in the next few weeks. And so as the money comes in, funds are in the account, we'll be able to make some decisions there. And all these places that we invest in are differently. Some of them you just have to put a small amount up front right now, pay a fee to get in, and you wait till the well's drilled. Some of them want some type of commitment to that drilling right up front. And so that's just the game we're going to have to play on our end to manage those deals and figure out which ones work for us right now. But we have not bought anything yet.
Speaking of good timing, Justin, asking any refrac. Can we speak to that?
Yeah, sure. So refracs is something that I know quite well. I've written some technical papers on it. It's kind of was an unknown area in the industry where operators, some at least, were going back into old wells and redoing them, for lack of a better word. There's tons of different ways that can be done. The oldest shale play in the US is the Barnett Shale. And the company name BKV came in and bought everything that everybody else used to own and started doing that. And they really made a name for themselves. And there are a lot of highlights out there. And so a lot of people caught attention of that and people started refracking wells. There's some risk involved with it. It's probably a little harder to do than drill a new well because you're running new equipment back into an old well that could have problems. But we're starting to see some of those come in the door. And in this case, this was due to some very, private one-on-one relationships that I had. And Tate and I have met with them a few times. And so we've seen a few refrac opportunities and we'll be considering them. They're very good economically, but we just need to make sure we're in there with an operator, that's not gonna mess it up. And then we've got, access to enough of them in case one of them doesn't work out. But more to come on that. Great
Excellent.
opportunities though.
Thanks, Mark. Definitely. Let's see. We got lots of good questions here. I'm going to jump to Brian's question about how much of a heads up will investors have before the wind up and exit. Lots of heads up. Obviously, we're going to be in a lot of different positions, and it likely is not all going to occur at once. It'll be sort of a cascade. When we enter years 6, 7, 8, we're going to be looking to start selling off assets, and it might be a multi-year process of winding down the fund. And so you might see a couple of years where you're recognizing pops here and there from asset sales. Dan's asking, why should I invest through Turbine versus other funds? I can tell you that we've looked at dozens of funds and we've structured this is the fund that I want to invest in, and we've built it from the ground up like that because we think that this is the best strategy that takes advantage of the largest amount of diversification across asset types, geographies, operators, strategies, like we just mentioned, refrac versus new drill. And so this is, to me, the lowest possible risk because you have your dollars spread around a minority interest in a lot of different wells. There are a lot of funds out there that might sell a 5-well package, and your $100,000 is exposed to the full 5 wells. And if there's a blowout, you've got massive GP liability because you're so exposed to that one well. And they're typically smaller. If they're operating their own wells, it's a small company versus, we're looking at participating with BP. We're not messing around with small operators who are raising retail capital. This is we're working with institutions here. So that's why I like this fund. That's why we've built it this way. And this is the strategy that we've landed on. This is what we're going to be doing every year going forward.
Hey, there's a question about natural gas futures and prices and kind of how we came up with our numbers and, kind of
Yeah.
in regards to the war. You want to show what the futures price is right now also? natural gas is always seasonably low during the summer. There are some questions as to why it's so low right now. But if you look at the future, those are solid prices that you could lock in right now if you wanted to. And to me, it's not counterintuitive given the geopolitical risk. I think this is just my opinion. Gas is going to be even more stable and even more valuable going forward than oil, just because of the geopolitical risk. So it's not that we want to be all in natural gas. Last year's fund was focused more towards oil. I just think a natural gas deal is going to be easier for us to get right now in the very beginning because we can probably agree on a price with someone a lot easier than someone that's trying to sell oil. Not that everybody's wanting, like we talked about earlier, that $100 oil. I've seen a lot of deals come off the market that were oil that are waiting for the price to settle down. Natural gas deals, I mean, what we just got one in the door today for Haynesville up near Shreveport, Louisiana. So I just feel like those are going to be easier to act on in the beginning. And we want a balance of both.
Yeah. Excellent. Thanks, Mark. Um, Another thing I'll add to that is the AI revolution, right?
Yep, you bet.
Data centers are booming right now, and I've gotten questions from investors saying, oh, are you going to have a data center investment? And I'm like, I don't want to touch data centers with a 10-foot pole because they're so overvalued. I mean, everybody's trying to pile into data centers. I think that investing in natural gas it's a way to get exposure to AI without actually investing in it. Yeah, personal opinion, but
Microsoft just announced a huge partnership with Chevron to build several out in West Texas. And
yeah.
there's announcements like that coming out every month.
TJ, what else we got?
Let's see. James Cheng had a great question about the oil well ramp up schedule. AK, can
Yes,
we chat a little bit about how these things are brought online and
I could
Mark.
talk about that. So, we're going to start bidding on wells. The likelihood of something coming on this year is pretty low, but we won't be able to go purchase everything we want right now. That'll happen as money, enters the fund. So every time we bid on a well, that's just to get in the door. Sometimes they're about to be drilled. Sometimes they've only been permitted and won't be drilled for several months. So much like the Iron Horse Fund, where we invested in the third and fourth quarter, and we've only got two or three of the 40 wells online right now. That's the same, kind of delay we're going to see. And then, we don't get paid instantly when the operator gets their first check. We've got to have relationships between accounting groups, and then checks can be delayed 2 to 3 months between the operator getting paid and the fund getting paid. And that's the nature of the business as a non-op partner, is they're in control. Wells will trickle in this year, and production, we might have some wells on production later this year, but more likely than not, it's not going to be till December of this year or January of next year before we see some substantial cash flow. And back to the capital, we can only buy what we have money for right now. So we just can't go buy everything that we're seeing right now. We'll buy, what we're able to commit to, and then we'll as more money comes in, we'll see what opportunities there are later in the year. We are going to be using a very stout accounting group that is used to chasing people down and getting money in the door and setting accounts up and knows how to do this business. So instead of hiring someone on our own and trying to teach them that, we found a very reputable group that's going to handle all of our non-op oil and gas accounting and making sure that we're getting paid on time.
Thanks, Mark.
fantastic? Rob had a really good question. Basically just comparing Iron Horse to this fund, to Waypoint Energy. So the question is Waypoint Energy fund better than the Iron Horse fund, or basically the same? I've invested in Iron Horse. Would it make sense to also invest in this fund? I'm mainly interested in the tax benefits to offset the high W-2 income.
Great question. So I would actually say that in many ways, Iron Horse and Waypoint are very, very similar. We made a few changes this year that we think make it better. We think that we took that product and we made a few tweaks. We upgraded it, but we really liked the fund strategy last year, and that's why we're keeping 95% of the fund strategy. We're just bringing it in-house. I've said this in the past that I like thinking of oil and gas as an every year strategy. I allocate personal capital to our oil and gas funds every single year. It reduces my tax liability and it gives me exposure to energy. And some years are just going to produce slightly better returns than others. And you don't know what vintage is going to perform really well or just okay because of where commodity prices go. And the first 18 to 24 months of the life of these wells are their most productive. So if commodity prices are really high during that window where the wells are giving off a ton of production, that is going to bode really well for the fund. If, on the contrary, prices slump and they're slumped for 12 plus months during that really productive window, you can shut off a gas well a lot easier than you can an oil well. You're typically, once those oil wells are flowing, you don't want to shut them in because you're gonna damage them, and when you start them back up, they're not going to flow at the same rate. Mark, I'm sure you'll back me up on that. Some years you're going to get lucky. Other years, going to be a little bit less lucky. But the reason we like the fund structure is that it's ultra diversified and it's about as low risk as you can get in an oil and gas deal because you're participating with these top tier operators and you're mixing some oil, some gas, a bunch of different basins, a bunch of different strategies. And so we feel like the blended average return of, a decade's worth of funds, Iron Horse included, will be very similar, or at least not, a boom and bust cycle like some more risky funds.
And I know we've been asked before, what kind of information are we gonna distribute? And so what we'd like to do, starting with Iron Horse, is once we've got enough wells on production, we'd like, instead of emailing a spreadsheet, we'd like to host a little Q&A session where I go into my analysis and show the results of the wells that have come on production and how we predict them to perform. And we're talking about doing a similar session later this year, just to kind of show my analysis process in detail. And then for this fund, it's going to be a while probably before we have wells on production and can analyze exactly how we think it's going to perform. But Iron Horse is a good example of that right now. The first 3 or 4 wells that came online, and they look great, but they've only got estimated production at this point. It's not even reported up through the state and government websites and software. But that's the kind of thing we will be paying, very much attention to.
Right. Justin's asking, can we elaborate on Mark's long-term commitment staying with the fund? Mark, you want to speak to that?
Yeah, Tate and I have talked about this a long time, and this isn't a quick making a quick buck, right? So the things that we invest in this year won't reap benefits till the next year, maybe and maybe even beyond. And then we've got to talk about flipping these deals later on. So that this is a 10-year run, in my opinion. And so that's how long we plan on doing this, if not a whole lot longer. And it's not a quick buck. It's a long-term program. And Tate's,
Yep.
I think, committed to having oil and gas around for a long time as well. And we're talking about building out a team as well. There's a lot that goes on behind the scenes. When you buy something, we're going to be very careful about adding people when they're not necessary. And so, we've contracted legal and accounting, but we may bring on someone else, say a landman or something like that, that can help us QC deals. Just as an example, I bid on something in an auction last week, but going through the data room and going through all the land records and make sure we're actually, before we cut a check, make sure we're actually getting what we thought we were going to get. It's quite an intensive process, and I'm glad someone else likes doing it. But we plan on building out a team, and what sets us apart, I think, from some of the other oil and gas funds is, the Turbine's been doing this for a while, and they've got a machine that's already in place and works well. Some of the other funds that you may have been approached by, that just started, they've had to figure out how to do, what Tate's been doing for a long time. They're having to figure out how to do that on the fly. And it's very nice for me to be able to just go get deals and plug it into an existing system.
Thanks, Mark. TJ, we got any other follow-up questions before we wrap?
That looks like it.
Okay. This has been a lot of fun, everyone. Thank you so much. turbinecap.com/Waypoint Energy. There you go. Easy to remember. Our text line, our office line. And if you have specific questions on oil and gas market, Turbine Cap, we threw you under the bus there, Mark. You're going to be
That's
getting a
fine.
bunch of emails there.
Bring it on.
Amazing. Happy to help everyone.
We're going to be in Dallas. Tate, someone asked about in-person
That's
meetings and
true.
conferences. I'll be there.
Yep. May 5th, Cinco de Mayo. We will be near the Irving Convention Center. We're going to be there for the TPNX conference, and we'll be throwing a happy hour on May 5th if anybody's in the Dallas area. Thanks everyone here for being here live. Look forward to providing just an incredible opportunity and an incredible fund for 2026. So thank you all. We couldn't be here without you, and we appreciate your trust, your support, your confidence, and we look forward to serving you on the Waypoint Energy vertical. So thanks,
Thanks,
everyone.
everyone.